Hey everyone, welcome back. In today's video, we're going to discuss the flash crash of 2010. So, for those of you that don't know, on May 6th, 2020, there was a 36-minute financial market crash. And in this time, the Dow Jones dropped nearly 10% before almost immediately recovering. And at the time, this was the second largest single intraday trading drop. And so if you look at the graph of the market taker for the Dow Jones Industrial Average on May 6th, you can see that it was a pretty normal day up until about 2:30 p.m. when all of a sudden the Dow peaked at a low point of nearly 1,000 points lost, or 9.2%, before almost immediately just rebounding and recovering pretty much all of these losses. So let's talk about the market situation on this day. So, you're thinking 2010, you're thinking about the recovery of the recession here in the United States. Well, if you think about our knowledge of the 2007 to 2009 financial crisis, it actually didn't hit the rest of the world until a little bit after that. So in 2010, there were a lot of fears about debt, specifically the country of Greece defaulting on their debt. So, there were some serious and valid concerns in the market that the country of Greece was going to have problems, that the euro was going to drop in value or collapse entirely, etc. And so the Dow Jones had already lost about 300 points by the time 2 p.m. rolled around. So, not a good day for the market by any means, but at the same time, not the end of the world, nothing unusual. But by 2:45 p.m., the Dow just had the floor pulled right out from under it. And by 3:15, it recovered pretty much all of this. It did end up down, but it only ended down about 300 points. So a pretty normal level for a day that is being fueled by bearish sentiments like what this crash was dealing with. But this has to be on your mind. What is going on to cause such a big drop in the market? And originally, the very first response was that this was all because of an incorrect trade on Procter and Gamble's stock. So, this was a market-wide problem, and all equities were hit. But Procter and Gamble specifically dropped by 37% before almost immediately recovering all of these losses. And so the idea was that there could have been a possible accidental massive sell order on Procter and Gamble stock. Some guy with this is called the heavy fingers hypothesis added a couple too many zeros on how much Procter and Gamble stock he wanted to sell. However, there are a lot of safeguards to prevent a heavy finger sale of this magnitude, so it's not a very reasonable prediction to make. Now, a more popular theory follows around this guy, Navinder Saral. He was a day trader out of his parents' basement, literally, that may have helped cause the flash crash. So, what Saral did is he recognized a major weakness with high frequency trading algorithms. Now, every financial company touts their innovative, unique, cutting edge software, but at the end of the day, most trading software pretty much follows the same line of reasoning, the same core algorithms, and the same motivation. So this meant that high frequency traders and algorithms were really just trading off of the same little bits of information. And so uh, what he did is he capitalized on how high frequency trading works. So the whole idea with high frequency trading algorithms is that when a market goes to, or when an order goes to the stock market for, a certain amount of stock, let's say you're buying 100 shares of Apple, that's not going to be immediately filled. You have to have a market maker where you want to sell someone needs to sell 100 shares of Apple for you to buy. And so before this order is completed, there's just going to be outstanding orders for Apple stock. So this is the equivalent of someone browsing in the store for dinner. They know that they're going to buy something. They may have put it in their cart, but they haven't actually bought it yet. However, nobody else can step in and take that food. So what high frequency traders do is they realized that there's a little bit of this very brief mismatch between what we know the market is going to do and what is happening in the market. You know that these 100 shares of Apple will be bought, uh, but they haven't been bought yet. So if the high frequency trading algorithms can squeeze in the market beforehand, they know that that sale of Apple stock is going to raise the market. So if they can quickly buy Apple at the lower price before the other 100 shares of Apple is completed, they know that the market will go up by a tiny bit, and then they'll immediately sell their Apple stock for a brief arbitrage profit. And we're talking about milliseconds of arbitrage opportunities here with high frequency trading. But what Sorrell realized is that for these high frequency algorithms to operate, they're operating on future transactions. So what he did is he spoofed these transactions. He created a software that would place large orders that would cause high frequency trading algorithms to move and to buy or sell stock, and then he would immediately cancel the order and then take the opposite side of the trade. So he's basically doing, he's forcing high frequency algorithms in a certain direction and then capitalizing on the predictability of that high frequency movement. And using just, a couple $1,000s, he made an estimated $40 million in just 5 years, just trading from his parents' house using his custom software. Now, Sorrell did get indicted, although he was only sentenced to 1 year of house arrest, but he was facing up to 320 years in jail. Uh, and a lot of it came down to it was not really provable that what Sorrell did could have affected the flash crash. Uh, his spoofing could have easily made the crash worse because a lot of what his spoofing software was doing was automated based off of predictable market activity so that it didn't seem suspicious what the spoof trades were doing. And so he could have been spoofing completely accidentally the demise or free fall of the market. And that caused these high frequency trading algorithms to actually cause the market to crash. However, is really, really hard to prove. And at bare minimum, Sorrell software alone doesn't seem like it is a plausible explanation for just the absolute free fall that we saw. But this conversation brings up an important point. It is undeniable that high frequency traders had a large impact on the crash because their entire design is to take advantage of sudden price changes, and they instigate them and make these sudden price changes larger. And so if we had just a period of synchronization in high frequency trading actions, which in 2010 was predicted or estimated to be about 20% of all market activity, it's not out of the realm of possibility that when we get this synchronization, we can see massive movements in the market. And you can argue about whether that's good or bad, whether it's corrupt or not, but it is interesting about the quantity of trading that is just done purely by computers, that there's no human drive whatsoever that's causing these market movements. Now, a final belief is that once again, this is rooted with high frequency trading, but it was actually started by a very large sale of E-mini S&P 500s. So this is just a basic S&P 500 futures product from a single seller, and that actually is what sparked these algorithmic trading features to believe that there was some sort of market arbitrage where the futures market is mismatched from the underlying S&P 500, and so these algorithms raced to drop the S&P 500 to meet this abnormally large E-mini S&P 500 sale. Additionally, there are a couple secondary hypotheses or contributors, such as the ETF market becoming unhinged because ETFs operate under this assumption of you need to require if the ETF is mismatched with the underlying portfolio, then you can just exchange your ETF for arbitrage profits. But in the short term, it is possible that these ETFs became unhinged from the underlying prices, and that caused, once again, these algorithms to try and capitalize on some sort of arbitrage in the market. But when we look at the SEC report, it really comes down to the combined selling pressure from the sell algorithm, HFTs, and other traders collectively drove the price of the E-mini S&P 500 down approximately 3% in just 4 minutes, beginning at 2:41 p.m. through the end of 2:44 p.m. During the same time, cross-market arbitrageurs did buy the E-mini S&P 500 simultaneously sold equivalent amounts in the equities market, driving the price of SPY also down approximately by 3%. So this really, uh, this quote summarizes what the SEC believes happened. So, obvious question at this point, what happened afterwards? There was a lot of finger pointing, but at the end of the day, we still will never know what caused specifically this flash crash. All that we do know is that uh, the value of the S&P 500 and the Dow Jones did not actually drop by this much, and so there was nothing structurally wrong in the equities market to cause the market to crash. So the simplest solution that these regulators came up with is say if there's nothing actually wrong trying to uh, that warrants the market going down, then nobody should have a problem with us pausing trading so that everybody can take a deep breath and reevaluate the situation. And so what these markets did is implemented circuit breakers that halt trading temporarily on it can either be on the market or on individual assets if certain volatility thresholds are reached, and they can go in both directions, up or down. And if you were following the news in March 2020, the biggest use of circuit breakers for the S&P 500 was actually in March of 2020 when we hit the circuit breaker thresholds 7 times in 1 week. So these circuit breakers, the idea, as I said, is just be to cause a pause in trading so that we can stop these algorithms from driving down prices further, and so that it gives time for regulators and investors alike to take a look at the market to try and figure out, if there's anything warranting this drop in prices, or if it's just, something fluky like the flash crash of 2010. There have been additional regulations and rules that have been proposed and some implemented even on high frequency trading, but a lot of people do consider them to either be incomplete and inadequate. So there's not a lot still prohibiting high frequency trading. And because that we have seen several crashes, they have calmed down considerably because high frequency trading has moved a little bit away from the equities market because there is a rapid reduction in arbitrage profits available in the equities market as the entire system comes up in line with a more technological modern development. But in specifically the futures market, we have seen quite a few crashes, such as when cocoa futures dropped 13% in a minute on March 1st of 2011, or even in the Forex market when the dollar dropped against the yen by 5% in 10 minutes. So we do still see these crashes that really don't seem to be spurred by anything other than algorithmic trading. Uh, but some people argue that, this is a major problem, that this is the outcome of a corrupt system, and other people just say, nobody is really hurt in the long term, and if we want this decentralized market structure that uses technological tools available, that we have to be willing to accept that every once in a while we get weird days such as the flash crash in 2010.